we look at the market on the close on Friday, it was at or about where the S&P 500 was when this was announced, almost exactly to the point. And I think the reason for that is we had this combination of there's significant fiscal policy being put into place by China, and the response has been very rapid. But in that entire time, our assumption was, okay, China's taking care of China's problem, and now this has become everybody's problem, right? So, we heard about 1 or 2 or 3 cases in Italy. That's 200 now. And the same thing is true in terms of the ramp up in the number of cases in Korea. So the market has to take notice now, and I think that's what we're seeing. I think that it's interesting that even with the percentage drop that we're seeing this morning in the S&P 500, it's stopping right at its moving average, which is incredible, but it's just a logical market. The other thing that's been logical about this market is it has really adversely affected those spaces, the travel and leisure, the restaurants, the gaming stocks, much more than it has some of those companies that are going to have temporary economic loss.
Is this a situation right now? You said that there could be some support as these markets hover around some moving averages, especially for the S&P. Is now the time then you start buying dips? Because let's be honest, it's worked for the past 6-7 years.
Yeah, it's worked for a long time, and I would tell you this: you just know where your levels are. I think 3258 is the exact number of the S&P 500, and oddly enough, that's at or about where we are. So give that time to hold. If that holds, I think this is a day where they're telling you this is the magnitude of how much they're going to flush these things today.
Is this a situation where you want to go deeper into those safe haven assets? Gold prices are extremely elevated right now. Treasury prices are extremely elevated. Yields are extremely low, near record lows, by the way. So do you want to go into those at these levels?
They are so stretched. Both gold started breaking out in December, and it's stretched. If you look at the RSI on gold, it's even higher than the RSI and the XLU, which is the utility ETF. The safeties have gotten very expensive, so I would be very careful. If you want to be defensive, I'd rather see you raise some cash than to plow into either gold, into the treasuries, into the utilities, except the consumer staples. They're very crowded right now, and much more than we've seen in years, as a matter of fact.